We talk about how everything that we've learned about finance, really from the boomers and from the greatest generation, is absolutely backwards from what we have to do now. Because all those things that they taught us about, save money and buy your house with cash. Yeah, that was great in 1948 and 1961 maybe, but it is not how we have to do it in 2025.
Wow, Mark, what I realized when I was working on my taxes for the year is that most of the deductions, the itemized deductions, are gone now. And so we should really talk about what's left and what's great about what's left. The first one, of course, being medical, which I obviously have had several years of having a lot of medical expenses because I got really, really sick with COVID. And it was very surprising to me, though, how much those bills just rack up so quickly. So grateful to be feeling so much better so I can join you all. But let's talk a little bit about medical expenses for those folks that are unfortunately dealing with that in this season of their life.
Yeah, we're very glad that you're back with us in strength. And medical expenses, especially as we get older in years, can really mess up everybody's retirement plans. There's this idea that when we pull our money out of our 401ks or our IRAs after we're 59 and a half, that our tax bracket will be quite a bit lower because we're retiring. Well, first of all, no one's retiring at 59 and a half. That's those days. It's not 1953, maybe 79 and a half, maybe 69 and a half, but not 59. So there's no real way for us to begin taking the required things out of your 401k. You have to take money out every year once you hit a certain age. And granted, that's quite a bit up there in the 70s, but still the money needs to start coming out, and that's going to raise your tax bracket. But what the other thing that people don't realize is that it isn't the amount of income that you're getting hit with a tax bracket. You're also having to pay medical expenses. Now, hopefully you have good insurance, and insurance obviously defrays the majority of those expenses, we hope, depending on your, if you have a health savings account or an FSA, as long as you had a good plan with good coverage, then great. But somewhere in there, you're going to have some significant medical expenses. And as you get older and older, those can easily require you to have to pull more money out of your retirement, thus bringing your tax bracket right back to where it was. And people don't really talk about this. So we need to be able to deduct those medical expenses that go way above, and even if slightly above, our standard deduction. Now here in 2025, we just had our standard deduction boosted up quite a bit more. It's over $15,000 now per person, which is great. And to be able to figure out how to itemize deductions at all, to take itemize, you're going to calculate the big few, which is medical, which we're going to talk about in a second, your local taxes, which includes your property tax, your sales tax, if you've kept receipts, and that's any sale. You don't have to have a business or anything, just sales tax. Interest on your property is another one that you can take as long as your loan is $750,000 or less. And if you just take those few and add those together, along with your charitable deductions, if it's greater than $15,000 a person, or the standard deduction, whatever year this is, you're watching it, then it's advantageous for you to file as an itemized deduction filer. That's Schedule A, if you didn't know. It used to be, like Sterling said, we had a ton of all kinds of itemized deductions and credits and things like this. Those are all gone and basically broken down into what we're going to talk about here in this podcast. The first one being medical. And medical is great. Not that we want to be spending money on medical. I get that. And the deductible medical expenses are only those that are medically necessary. So you have to be able to prove that the vitamins and the supplements that you're taking are actually good for you and medically necessary. And if you can do that, then great, you can deduct them. But here's the rule. Unlike with the C corporation, which has a cap on the top, we as social slaves have a cap on the bottom. The AGI, that's your adjusted gross income. It says so on where that is on the 1040 form. Your AGI is, once you figure out what that is, your medical expenses have to be 7.5% greater than your AGI. Your adjusted gross income. So for example, if you have a $100,000 AGI and you have $10,000 in medical expenses, 7.5% is $7,500. That means you have $2,500 left over of your $10,000 medical expenses that you get to deduct off of your off of your Schedule A, your itemized deductions. And that's pretty much how it is. It's a really easy math. It's not hard. Just as long as your expenses are above that 7.5% of your AGI, everything above that is deductible. Yeah. Like, I broke my leg one year and had to spend a mid-5-figure number on having things repaired, even with insurance. And that was a really nice tax year where, I basically paid no tax because my itemized deductions were so high because of the medical side.
Yes, it's never usually the expense that you're expecting, right? And oftentimes not the time of life you're expecting it. That's the one thing about. It was the one thing about. The pandemic is it was not a respecter of person about age or anything else. So, Wow. Okay. So if we lost all these deductions besides medical, let's talk about the one that's always so surprising to me, which is the sales tax deduction. Now, Mark and I have known each other for 20 years. And for 20 years, I have watched this man literally save every tiny scrap of paper ever that's a receipt. And I thought, I don't know why he does this. This doesn't make any sense to me. Until finally the light bulb came on about why it is that he's saving all these tiny little slips of paper. And now I'm the person in our community hounding everyone about the fact they have to save every single receipt every single time. So let's talk about sales tax deduction.
Yeah, the one that nobody talks about. And everybody should be talking about right now, because with the big, beautiful bill, they just changed the rules. The rules used to be you either took the sales tax deduction or your local tax deduction, which we're going to talk about in a second. They can never be more than $10,000. Now, look, $10,000 on the single side, if you're single or married filing separately or had a household, that's a thing. That's a big deal, especially if you're only trying to get over the $15,000 standard deduction. So let's say you got a few $1,000s in medical, some charitable deductions, and a $10,000 sales tax deduction. You definitely want to itemize. And most people should, because if you're in a state like I am here in Tennessee, where sales tax is 10%, that means if you spent $100,000 on things, food, clothing, whatever that is, that's going to max out. You're going to be in a good space. But it used to be either the sales tax deduction or the local tax meaning also your property tax. That's included. One of the reasons we don't talk about sales tax deduction, and I say we, by that I mean us tax preparers, is because we're generally told by the IRS that we don't want to share with clients particular deductions that have a big burden of proof. So this has probably one of the biggest burdens of proof, which is got to keep all your receipts all year. That's a lot of receipts to have to go through and prove. And you can't use a credit card statement because the credit card statement does not delineate the sales tax portion, only the total portion. So that doesn't work. You have to have the sales tax, you have to have the receipts. But now with the big, beautiful bill, not only do we get the sales tax deduction, married filing jointly folks get a bump from $10,000 to $20,000 on the sales tax deduction, and we can claim the local tax deductions up to $40,000 total. So what does that mean? So if I'm single, which I am, and I've got a $10,000 sales tax deduction, which I'm going to take if I can, then if I have a big, beautiful house in San Diego County, Southern California, that's charging me $30,000 a year in property taxes, I can now take all $30,000 of that property tax and the $10,000 from the sales tax, bundle them together for a $40,000 deduction on my Schedule A itemized deductions. If you're married filing jointly, it could be $20,000 and $20,000 for a 40. And that's going to be available to us through 2029, which is unbelievable. Right now, for everybody who's getting a lot of personal income, it's free cash for the next, whatever it is, 4 years, 5 years. Thanks so much for joining us here on Stacks Over Tax. And if you have enjoyed being with us so far as much as we've enjoyed being with you, smash that subscribe button and make sure you hit the little bell for notifications so that every time we put out a new video or any other kind of content, you're notified and you can have the great time again with us. Thanks so much.
Wow, that's amazing, Mark. Okay, totally worth it to save all the receipts and chase the people down when they don't give you one. So
yeah. But we were talking about a G-Wagon earlier. Well, if you buy a $200,000 G-Wagon at 10% here in Tennessee, that's your $20,000 right there.
Maybe we got to go shopping more often. No, we're learning to invest these days. That's what we're working on. We're not working on shopping. We're learning to be a person who invests money, not spends money. So
that's correct. Well, and in one of our other podcasts, we talk about how everything that we've learned about finance from the boomers and from the greatest generation is absolutely backwards from what we have to do now. Because all those things that they taught us about, save money and, buy your house with cash. Yeah, that was great in 1948 and 1961, maybe, but it is not how we have to do it in 2025.
Nope, it's not going to get us there. However, the lottery might. So the lottery's been exceptionally high lately. And so high, I think I even convinced you to go buy a ticket, didn't I?
You didn't convince me, but you said it was very convincing.
It was very convincing. So,
yes.
Yeah. But, obviously I didn't win yet. So I'm convinced I'm going to win the lottery, but I haven't won yet. So tell me about my gambling losses, because now I think I'm up to like $50 this year in lottery tickets, which is a lot of lottery tickets for me.
With no winnings?
But I think I won $4 the other day, which was the concern I had, because I remember you told me that I can claim my deductions about losses up to the point that I won. Well, when I won the little $4, they took my ticket. And then I realized, how am I going to prove I won $4? So that's the question I have. Tell me about lotteries and gambling losses. And should other people have potentially maybe other gambling habits that are not a $50 problem?
Well, I don't know. A $50 problem sounds like a pretty good problem compared to most people's gambling habit problems. I mean, it's hard to watch Netflix now without, FanDuel coming on or some other gambling thing. I'm like, really? Okay, great. If you're good at that kind of thing.
Well, I think it's fascinating that they only direct those ads to men. No woman I know gets any gambling ads at all. It's one of the things I've been looking at when it comes to advertising that's done to men and women, is we don't get advertising for things that are risk behaviors. Mm-hmm. They advertise risk behaviors to men.
That's fascinating.
Right. Uh-huh.
It's actually not fascinating. It's not surprising. Not surprising when these mega corporations have sunk billions of dollars into psychographics to know exactly what will appeal. Yeah. Why would you send a high risk advertisement to the female? Why would you do that?
Yeah. So if you're a woman watching this, get your guy to turn on, show you on his Instagram what gets advertised to him, and his Facebook what gets advertised to him, even his YouTube account what gets advertised to him. It is radically different than what they're advertising to you. Mm-hmm. So not only do we have the pink tax on razors, we're not getting invited to the party when it comes to gambling. So
it's true. And so in that, I mean, look, I understand gambling. I've been thrown out of more than one casino for counting cards. So
that's a different episode.
In blackjack is what I mean. So yeah, don't do that anymore. Can't really do that. Just keep walking, Lewis, by the casino. Keep walking. So gambling losses are deductible on your Schedule A, the itemized, as long as what you're deducting is not greater than your winnings. So in your case, Sterling, you lost $50 and won $4, so you can deduct $4 of your losses. That's simple math.
But how do I prove the 4 that I won?
If they took your ticket, I don't know. I really did. That's bad. I don't know.
I know.
You should have told them that was your private property.
Receipt. I wasn't sure what to ask for, so I just gave them the ticket.
Yeah, you should get a receipt for that, because remember, the lottery ticket is your property. The money is what you get in exchange for giving them your property, which is the winning ticket. So the money is not yours, the ticket is. Once you give them the ticket, then you've given them the right to be the holder in due course of that particular negotiable instrument that they negotiate, in your case, for $4. But they should still give you a receipt for you giving them something.
Next time I will go somewhere potentially higher in education than the local gas station. So,
Yeah.
So,
Yes, please.
need a bookie to turn in my lottery ticket, apparently.
Yeah. With security.
With security. So for $4.
Mm-hmm.
So far, I'm committed to winning. I remember you talking about casualty and theft, and how is that work?
Yeah. So if you've got somebody comes in, like I was robbed by at gunpoint many years ago in my own house, and a whole bunch of equipment in the studio I had at that time was taken and stolen. The difference between what the insurance pays you, because obviously you can't write off all your losses if insurance reimburses you. That's tax fraud. You can't do that. But whatever the difference is, if there is a difference, then that is deductible off your Schedule A as well. Also, if the difference is in your favor, that's taxable. So if you lost $100,000 of stuff and the fair market value and the insurance pays you $110,000, you just have a $10,000 taxable event. So be careful about that. Casualty is the same. If you had a loss on your house because there was a flood, like I did several years ago, over $100,000, that can be deducted as well. So casualty, losses, those kinds of things that were not a part of your plan at all, but left you in the hole, deductible on Schedule A. Especially, I'll also say, and in particular, if you're in a federally declared disaster area.
Right. Yeah. Like here in Los Angeles, we have 10,000 people who lost their home, and they are obviously getting insurance money, but as you could probably imagine, a lot of it would not cover a rebuild to be done in those areas. And so now their properties now going up on the market. I'm watching that happen over in the Pasadena area and the Palisades area. And the market value is, it's somebody's going to get a great deal. So
pennies on the dollar. Yeah. Same with Ashland, North Carolina, that whole area after the hurricane.
On a much more fun note, let's talk about property taxes, because that's a huge deduction for people, especially depending upon where you live. Like our property taxes in Los Angeles are insane. A little bit less than Tennessee, but let's talk about how that works for folks.
A lot more than Tennessee. I mean, we're doing like pennies on the square. We're doing like pennies on the percentage here. But in California, you're in the 5 figures for property taxes. And until recently, we talked about earlier in this podcast, recently you either had to choose the sales tax deduction or the local tax property tax deduction. But now you get included up to a $40,000 max with your sales tax deduction, which makes those people who are living in high value real estate states, puts them in a really, really great position, a position that we've not actually ever seen, which is that a $40,000 itemized tax deduction is available. Pretty great. Up until 2029.
And then if you still have a loan on your property, you can deduct the interest as well. But I remember you saying that there's some sort of cap about how much that needs to be. What is that?
Yeah. You get all the interest deductible up to a loan that's $750,000. Above that, then it's any money on the loan that's above that, the interest doesn't count. So you'd have to create some kind of a ratio. So if it was a $1.5 million loan, you could only deduct half of the interest, that kind of situation. But the first $750,000 of that loan, interest is tax-free.
Health insurance is a big topic these days. Can you tell us a little bit about how that works for folks, like myself that are self-employed, how that works on our taxes? Because I'm not entirely sure. I sort of still depend on my CPA. I give him all the information and then I just hope to God that he knows what he's doing. Now, I have a really great CPA, which is amazing, but I know most folks don't. So how does this work for health insurance?
Well, health insurance for self-employed is really, really great. You basically get to write off all the health insurance premiums you personally pay. Now, this has nothing to do if you have a W-2 job and your company's paying for that. That is not it at all. Or if you're personally paying for health insurance and you're W-2, or if you're an owner of a company or anything like that, that does not count. Only if you have self-employment income. Self-employment income also includes guaranteed payments, which are not qualified business income. So you don't get the deduction on guaranteed payments from LLCs, but does count as self-employment income for the health insurance deduction. And the limit is you can deduct all of the health insurance premiums that you've paid for yourself and your family as long as it's less than the profit that you made from self-employment income. So if you have $10,000 this year of health insurance premiums and you have $12,000 of self-employment income, you can deduct all the health insurance premiums that you earned, that you had to pay this year. It's a pretty great deal, especially when you consider combining that with an HSA so that your health insurance premiums, because the HSA cannot pay for health insurance premiums. That's an interesting thing to say. The health savings account can pay for all your medically necessary procedures and things and drugs and all that, but cannot pay for the health insurance premium. But your health insurance premium is tax deductible if you're self-employed.
Okay. And just to be clear, my HSA can pay the deductible though, right?
Yes, it can. Absolutely. It's kind of the purpose of an HSA, really, especially in the beginning when when your deductible might be $4,000 and your first contribution is $4,300. So it'll cover that.
Let's talk about one of my favorite deductions, which is charity. Mm-hmm. I'm a big person who believes in philanthropy and giving back in your community. And so let's talk about what the guidelines are around charity and giving and how that's changed.
Charity is obviously important from an energetic standpoint, much less a tax standpoint. You donating your effort is not the same as you donating your money. Now, remember, you going and donating time and effort and those kinds of things is never tax deductible, never. You can donate a car as a charitable donation, but that's still a thing that you're donating that you'll get a receipt for and get a donation from. But in the tax world, we need to be really sure, especially for those of you who do regular donations to things like, let's say, churches, you don't get a deduction for charity if the aggregate donations that you've made for the year are less than your standard deduction. And for those of you who are married filing jointly, that's $30,000+ a year. And if you've only donated $20,000 and you really don't have any other itemized deductions, you're going to lose the tax benefit because the standard deduction is already going to cover that. If you're donating for tax purposes, which hopefully that's not the only reason you're donating, donate to be sure that you're going to go in combination with the other deductions we've talked about, the medical, the SALT, the property tax. Make sure that's going to push you over the standard deduction. Otherwise, you're going to lose that deduction. Now, one of the new things that happened is that we now have a floor on charitable deductions for the first time since I've been alive, as far as I know. And that is that you have to donate more than 0.5% of your adjusted gross income. But really, that's sort of inconsequential because for that to matter at all anyway, you have to get over your standard deduction. Now, unless you're making millions and millions of dollars, then yes, then that will certainly matter because 0.5% of $10 million is $50,000. So you'd have to get over that. But, and then the standard deduction doesn't matter at that point. You're trying to get over 50,000. So in any case, the charitable deduction is great. It's a cold, hard deduction, comes off your Schedule A, but now has to be over 0.5% of your AGI or, in parentheses, over your standard deduction. Otherwise, you'll lose it.
That is a huge difference in the way that it used to be. One of the itemized deductions that I don't think people at all understand about until, unfortunately, someone passes is about the estate tax deduction. And, the entire process of probate is extremely confusing. And that person is already in a state of grieving. And if so, educating people prior to them getting to that state is one of the things we're really committed to. So legacy preservation is a huge pillar of our business. And I thought you could talk a little bit about the estate tax deduction and how that works. Yeah,
the estate tax deduction is for people who sadly didn't plan well enough and have taxation on their estates when they pass by the federal government. Some states have inheritance taxes tacked on top of that, which also applies. But so if you have an estate that's greater than $15 million for you, and if it's married filing jointly, then it's 30, we just had that upped, then all the assets that you have over that amount are taxed at 40%. 40%. One of the worst taxes we have. But at least on the itemized side of your 1040, your social slave tax, those taxes are deductible. We can never deduct federal tax, the income tax, and we can deduct the state taxes if they're local. We talked about that in the $40,000 range, but we can never deduct income tax, but the estate tax we can deduct, which again is a horrible tax. And if you're having to pay the estate tax, you probably didn't talk to us, and you definitely didn't plan your estate quite well. Right now, I know it's going to be heinous for Prince, the artist formerly named Prince, who made no plans for his estate, and that estate will be in probate for years and years to come while his family fights over it. Don't be that person. Make sure you get your estate planned, not only so that it's clearly has a chain of title and all those things after you pass, but that we avoid government involvement and, most importantly, government taxation.
It's just such a tragedy. They could easily be avoided with some education, and that's one of the things I love about what we do here. And if you need some more information about working on your plan, whether that's with trusts or learning more about how probate can impact you, please reach out to us. We would love to help you out and make sure that you are set up really, really well. Mark, where all can they find us?
Well, that's a good question. The easiest thing to do is just go to our website, executivemoneystrategies.com, and lots of stuff to fill your bandwidth there. Of course, here on YouTube, you can always reach out to us, and we'll get the emails that you send here, and certainly comment. We love comments and below, and if you have any questions, we can run you that way. And then if you'd like to set up an appointment with us, we can do that too. And just reach out and we'll get you connected there.
That's amazing. Thanks so much. This has been such a great episode to help people get ready for the tax season and plan ahead for next year. Wow. If you learned so much with us today and you want some more information about wealth strategies, make sure and check out our next video.